Good Tuesday afternoon to you. Welcome to the Jon Sanchez Show on News Talk KOH. It's a pleasure to be with you and a pleasure to be with my co-hosts. Around the horn we shall go. Dwight Millard, Highlands Mortgage. How are you, Big D?
I'm doing fantastic, John. How are you?
Good. Very good. Very good. The soon-to-be birthday boy, Corey Edge of Edge Realty, turning the big 5-0 tomorrow. Corey, I mean, come on, man. You only have 9 hours. Actually, 8 hours and 53 minutes till you're hitting the big 5-0. You realize that's halfway through life. Just want to remind you of that.
Well, a couple things on that. There were a lot of people that didn't think I'd make it to 50, so let's not, you're kind of jinxing me here with this 9-hour thing, because that's a lot of time left. And I had another buddy of mine say, "Oh man, you're halfway." I'm like, "No, I'm more like 2/3."
About 2/3,
yeah.
That's about that's in reality. But with AI, Corey, like I keep telling clients, with AI, I mean, I think 100 is going to be the new 70 or 75. I think it's just going to extend everybody's life.
I might be ready to pack it in right around 90. We'll see how things go in the next 40 years, but it might be time to call it quits.
See how interest rates and the real estate market treats you.
Yeah, I mean, the personal stuff's great. It's all this government. I mean, maybe we find a small island that doesn't have all the chaos and no stress. That'd be nice.
I hear you. That's good stuff. That is good stuff. Any big plans for the 5-0? I mean, it's right before Thanksgiving. So, I guess you can say you're almost guaranteed a big birthday dinner, right?
Yes, yeah, a big dinner, usually multiple cakes, family members in town. It's always always fun. Like I joked with you, if I can get out of bed without any aches and pains, it'll be a good day. So
and as I told Corey when he said that off air, I said, wait till you're 60. Then you're going to really feel the aches and pains like me and Dwight.
Yeah, I bet.
Oh, goodness. All right. Well, let me tell you what we have lined up for you, folks. We're going to recap today's very stellar stock market day. What a day it was. My goodness. Strong buying right across the board. Give you all the details on that very quickly. And then we're going to get into our real estate topic that we did not get to on Tuesday. We had some other very important things to talk about. But today we're going to be focusing on something extremely important for those of you that own real estate, which is probably the majority of you. We're going to be tackling one of the most powerful, but yet dangerous tools in wealth building, and that is leveraging your real estate. When does it make sense? When should you absolutely avoid it? And how do you turn equity into long-term wealth without putting your financial future at risk? We're going to break it all down for you on that. So guys, this is a really interesting topic right now. Dwight, you and I have chatted many times off air about the amount of equity that is available around the country. We've done shows on this. Are you seeing people coming to you wanting to take some of this equity out, whether it's to live, whether it's to leverage into other real estate, other investments, maybe a small business? What's kind of the trend real quick before we get to the stock market?
Yeah, John, 100%. You're starting to see a lot of interest in home equity lines of credit. You're not seeing a lot of cash out yet, but I think people are kind of on hold on that. But yeah, people are now realizing how much equity they have and how easy it can be to tap. So yeah, you're starting to see definitely some accelerated interest in that.
Yes, indeed. Corey, what about you?
Yeah, there's definitely discussions about it, and we've talked about it for so long. There's so much untapped equity just sitting there, and it feels like, for a lot of people, it's a big piece of their net worth, and they can only sit for so long without, getting access to it or wanting to spend it or, kind of all these different things. So there's definitely chatter out there about getting their hands on it for sure.
Bet. Well, good. So, folks, what you're going to be picking up from us this afternoon is really, when should you leverage this real estate, right? When should you leverage it? Because leverage can be a scary word. It can be a very positive word if it's used correctly. And we're not going to go into, oh, hey, you know what? Don't take equity out of your house to go buy a new boat or a quad or something. No, we're talking on the business side of things, right? What do we need to look at to leverage that into more whether it's cash flow producing assets, growth oriented assets, or a combination thereof? So we're going to talk about, things like when the cash flow supports the new debt. That's one thing that can justify you taking out the or doing the leverage. When you can redeploy the equity into higher return assets. I mean, list goes on and on. We got about 6-7 bullet points for you. So it's going to be really good for those of you that are thinking about this. Maybe not so much this year, maybe next year. Maybe you're going to sit back and wait for rates to drop a little bit before you pull the trigger. But Dwight, I know we usually wait on you, but I want to get right to you because your world, the bond world, really was a catalyst into the substantial gains in the stock market today. I about fell out of my chair when I looked at the 30-year mortgage down. Well, so the 10-year folks down 4 basis points today, a 4% yield. So right on that mark. But Dwight, tell the audience what happened on the 30-year mortgage today, because this was a huge move for you.
Yeah, I mean these are good days. You had a 12 basis point improvement. You went from the 6.32 to 6.20. That's a big movement, John,
Big
in
move.
one day. I don't particularly like these kind of swings, but when they go in my favor or our favor, sure we'll take them. So, but the good news is if you look at the the government's look at the 15-year fix. We're back in 5.75 range.
There you go.
Well, I mean, these are, and John, I'm interested to hear, kind of what you think the pulse is of what's driving these rates down, because I still think that, I don't know, maybe there's an improvement on the possibility of a Fed,
There
drop in.
absolutely is.
Okay.
Yes, you hit it right on the head, Dwight. There absolutely is. Well, let's answer that question, Dwight, because I think that's on the mind of a lot of our listeners. Because again, it's influenced both the stock market and obviously the mortgage side of things. So you guys know this, but if those of you that may not be following the market real closer, maybe you've missed a show or two. The trend in it really started last Friday when we had Fed voting member Williams basically come out and say, in a roundabout way, he's supporting an interest rate cut in December, and that took us out of our funk that we experienced last week in the stock market. Things began to rip roar higher Friday, yesterday, and even today. So Dwight, that's exactly right. Now, today we finally had, I'm going to call it really the first day back in school, meaning we finally got our hands on some economic data today. And yes, it was September's data, but at least it's starting to give us a little bit of a glimpse as to what's going on in the labor market and so on and so forth. But back to your point, Dwight, really, one of the most interesting things is, this probability now is north of 70% and remember, it had dropped to low 40s, if I remember correctly, last week. It's now north of 70% in regards to the probability of a December interest rate cut. So now the street's gone from, hey, we're definitely going to have one, to, oh no, we're not going to have one, to, hey, we're pretty confident that we're going to have one. So I think that was one of the driving forces there, Dwight. That compounded with some of the data that I'll go over, again, gave the mortgage market. I mean, Dwight, this was a very big move. I mean, 12 basis points lower on the 30-year mortgage when the 10-year, again, was only down 4 basis points. There's usually not that big of a spread between the two.
Well, you start to wonder, John, apparently it's an influx into the mortgage-backed security market, right?
Mm-hmm.
They want the coupon.
Right.
So, maybe there's an appetite, for better words, towards the Treasury and towards the mortgage-backed securities, which tend to run hand in hand. I mean, the Treasuries tend to play a little better, but today was a mortgage-backed security day.
Well, what we may be seeing, Dwight, under the surface is, back to your question, is investors seeking yield. And when I say investors, I mean primarily the institutional side, specifically, because they're the ones that move the market. And that is, now that the market is very convinced of a December interest rate cut, and then again, one of many, I'm going to let Corey comment on, who our next Fed chairman is going to be, because we had some news on that. I know Corey followed that situation. But I think investors on the institutional side, Dwight, may be trying to get out in front of the bus a little bit and start getting into some areas that are paying decent yields, right, compared to, just say, treasuries. And of course, that's usually going to be your Ginnie Maes and Fannie Maes and some of those mortgage-backed securities. They tend to pay a little bit more than again what pure government treasuries do. So that's the other situation that I think is going on there, and the reason you had that big spread today. So you had more Fed members, back to that scenario. You had more Fed members today talk about the likelihood of a Fed cut. I mean, you had Fed Governor Stephen Moran, who is a voting member. He told CNBC today that he will not dissent at the next meeting in favor of larger rate cuts, because there are other FOMC members who will vote to keep rates unchanged. So remember, he was one of the big dissenters. And then, Corey, let's talk real quickly about the news that also, we were kind of languishing early this morning, and then this news story broke indicating that President Trump is probably going to name his next Federal Reserve chairman by Christmas. And Corey, of course, Kevin Bessent, his name's got thrown into that seems to be who the street wants. And Bessent has said, no, I'm not going to do it. And White House won't confirm one way or the other.
Yeah. And so I think any of those things, I think you've said it so many times, the market is looking 6 to 12 months ahead. So now they're in that mode of saying, we love Jerome Powell, but he's going to be gone. So if you give me somebody who's going to lower rates, no matter what, the long-term implications of that may not be good, but in the 24 to 36 months of the market looking at it saying, hey, lower rates, that's good for equities, we'll deal with the chaos that may ensue after that later. And it's good for all that stuff. So it'll be very interesting, especially if he names them before Christmas.
Yes, it will be. Yeah, and that could be that could be a nice boost to start the new year off, right? I mean, historically, January is usually a pretty good month for the market. But if we got that boost going into January, going, hey, we know who's going to be running the Fed. Yeah, I think that could be an excellent catalyst to get 2026 started in the right foot. And I stand corrected, guys. I just refreshed my numbers from earlier this morning. We finished with the CME FedWatch tool showing an 82.7% probability now. So it jumped up from midday last time that I checked it up to 82.7% probability of a 0.25% cut. Yesterday it was 84.4%. So yeah, very, very strong odds. It'd be interesting to see if we can get this thing back in that 90% range, which
well, John, that supports pretty much everybody's forecast, Fannie, Freddie, volume next year. They're talking about some significant volume.
Are they really, Dwight? Really? I did not know that.
So it's an improved volume from 25, which everybody's going to welcome, right?
Yeah, maybe they know something we don't know.
Maybe
that ties right in. That ties right in. All right, let's see. We probably need to run a break. Let's go to break, get this over with. We'll come back, and then a couple more things I want to mention on today's market activity, and then we're going to get into our topic: unlocking your equity when borrowing becomes a wealth strategy. Let's turn it over to Kristen Snow right now, Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on Newstalk 780 KOH with Dwight Millard of Highlands Mortgage, Corey Edge of Edge Realty. All right, here's how we finished up in this stellar day today. 64-point gain on the Dow, 1.43% to a close of 47,112. NASDAQ rose 154.67%, closing at 23,025. S&P up 61 points, 0.91% at 67.65. By the way, the resistance level, the 50-day moving average we got to watch tomorrow is 67.70 on the S&P. If we can break through that, most likely going higher. If we don't, and we hit that, could be going down a little bit. Futures right now just very quiet. And the Russell 2000, the star percentage, 2.14% gain there. So it was a great day across the board. Now, real quickly, guys, before we get to our topic, unlocking your equity, a lot of reports, like I said earlier. I'm just going to hit some of the high points. First of all, we had retail sales. We watched that one very closely to gauge the consumer retail sales up 0.2% month over month. Again, all this is September. That was just a small increase compared to August when we were up 0.6%. Strip out autos only up 0.3%. A producer's price index, of course, the measure of inflation on the wholesale side, up 0.3% month over month, following a 0.1% decline in August. That left the year-over-year PPI up 2.7% versus August year-over-year up 2.6%. Consumer confidence, another very important report. Well, the market should have dipped on this one, and it didn't. Consumer confidence number dipped to a reading of 88.7. This was November's data, by the way, from a revised 95.5 in October. Just remember, the higher number, there's no set specific, like 150 is the ultimate. You just want that number to be increasing, and obviously it reversed. Same period a year ago, just to give you an idea, that consumer confidence reading was at 112.8. Again, we're at 88.7. So,
John, and we've been talking about this for months.
Yeah,
right?
Exactly, Dwight. Yep.
The consumer is just fried right now. And
yep.
Those are big swings, aren't they, from a year ago?
That's a huge swing. Yeah, that's a huge swing. And that concerned me. Like I said, normally, I mean, I've seen this market move hundreds of points up or down. Because remember, we went through a period a few months ago, Dwight and Corey, where that consumer confidence number, it was a miss month after month. And man, it just pounded the market. And again, this was a terrible number, but everyone's kind of looking at everything else. I think today we had some short cover rally going on also, just to be honest with you. But anyways, yeah, Dwight, and the takeaway of the report was consumers are expecting further deterioration. The sentiment on business conditions was down. Labor market conditions were concerning. Household income all trending negatively. And again, the takeaway was this could ultimately lead to a slowdown in discretionary spending activity, which is terrible words to Wall Street because 2/3 of economic spending is you and I as the consumer. Corey, we had October pending home sales up about 1.9%. Nothing major there, right? Not a big move.
No, but it was interesting to listen to them talk about it because they saw kind of a more robust October.
We can't hear you, Corey. We've got a little glitch there. Anyways, yeah, not a big move on that side of things, on the pending home sales side. Big movers today. Again, where do you start? NVIDIA was on the downside. Supposedly, our day got started. Google, it was announced that Google won a big chip contract where Meta is going to choose Google chips over NVIDIA's. And so Google was another strong performer, up $5.17. Last 3 days, stocks has been on a tear. NVIDIA, though, down $4.73 to $177.82. Meta, 23% $93.17 rise, 3.78% to a close of $636.22. And Advanced Micro Devices finishing lower after had some pretty good trading in the early part of the day, but finished down 4.15%, $8.92 to 206.13. Corey, did you want to make any comments on the pending home sales? Again, just kind of a lackluster number, up just 1.7%.
Yeah, but I think it was better than they thought for October, which is what we saw.
Corey. Still not able to hear you. Doggone it. All right, we'll get Corey
John,
corrected here.
I think that the market was expecting that number. I don't think, to your point, I don't think it was anything that
right.
It was a yawner. I think it was encouraging because it could get on the other way, right? But
yes, yeah. Oh yeah, no, it can always go one or two ways.
And you got to start there to get the new home. I mean, that's the resale market that Corey talks about.
Yeah, that's right. Absolutely. So, like I said, overall not bad. 86-cent loss on oil, finished at $58 a barrel. Strong day for gold, $45.80 rise, 4,140.30. As we said, down 4 basis points on the 10-year to a close of 4%, right on the nose. All right, let's get things started. When should you leverage the real estate? When is it time to do it? So let's start off, Dwight, with something you have to look at as we're recorded to jump back in. This is something, of course, Dwight, that you have to look at in order to decide if you're going to grant a loan or not. And that is when the cash flow easily supports the new debt. Talk to us about your bullet points here.
Well, yeah, so if you're looking, buying a rental or a multifamily or something like that, I mean, it's so much easier. We rely primarily on the appraisers on what the typical unit or units will generate. As long as there are now loan programs out there, John, that strictly do debt servicing. So if your payment is $1 less than what the total rents received, approved.
Wow.
But it's, and then you got to, you have to, along with that, go with the stress test. You have to make assumptions, whether or not you're going to, whether or not you're going to have drop in rents. I mean, as the market gets competitive, you're starting to see that a little bit, those cracks in Northern Nevada right now. I mean, we're getting notifications, and you see from rental organizations and apartments that their rents have dropped, so.
Yes, that's true.
Yeah. And then you always got to factor in the vacancy factor, John, like you said, on any property, or anything you do, you got to make sure that it's going to cost more. I mean, Fannie and Freddie use 25%, but that's kind of heavy, but it's always going to cost more than you think when you get a vacancy, especially if they leave the place in not such a
okay. So that's a real interesting point you bring up. So you're saying Fannie and Freddie, if they are the ones ultimately buying the loan, and the calculations you have to present to them, they assume a 25% vacancy. That's huge.
Right. And you can argue in Reno, even anywhere in Northern Nevada, that it's way less than that, but you can't get away with it. They use 25, but I guess that's good because then it, and really, John, in simple terms, he says, if you're getting $1,000 in rent, I can only give you $750.
Right.
To offset the payment. So, I mean, it gives them a little bit of a little bit of a buffer zone.
So let me ask you this, Dwight, with that criteria, with this stress test, I like your term there. You're really looking at approving this loan to take the equity out to leverage it. You're looking at it from two standpoints. First one you're looking at is, as you said, can the borrower afford the payment if there is a 25% vacancy? But then you're also still looking at the strength of the borrower, right?
Yeah. Yeah. Can they weather? Yeah. Can they weather the storm? But yeah, we still have to take them down that natural, qualification route, assets, income, credit, all of that. But if they have all those goods and the rents are equal or greater, it makes that transaction a little more smoother for that borrower. I mean, it always helps. Upside down doesn't help.
Yeah.
And Corey would always say, why are you buying something that's not upside down?
Yeah. Okay, beautiful. I like that first point. When the cash flow easily supports the new debt, then it makes sense to leverage your real estate. We'll come back with point number 2 and many more when we return. Let's turn it over to Ryan Nutter. He's got news, traffic, and weather. Mr. Nutter, great to have you, my friend. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Corey Edge Realty, Dwight Millard of Highlands Mortgage. All right, once again, very stellar day today. 664 gain on the Dow. NASDAQ rose 154. S&P up 61. Now, we started the show by wishing Corey an early birthday. He turns the big 50 tomorrow. But at the same time, we need to do a belated birthday because our dear friend, Mr. Dwight Millard, turned my age, 61, but 3 days ago, the 22nd of November.
Yes.
So happy belated birthday, buddy.
Happy birthday, buddy.
I appreciate it.
If I wasn't turning 50, I would have remembered that.
I don't remember 50 anymore. Do you, John?
No, I don't. Last birthday I remember was age 45 when they roasted me. The NBC and KOH and all my friends at those two places, they roasted me at, I think, where were we? The Pepper Mill. And that was the last time that I've been that drunk. The last time where it's like, the puking drunk. That was the last time. And I don't claim any responsibility to that one. It was my family and all my friends that pushed me to that one.
I have to tell you now.
I remember.
I have to tell you, John, now that I'm this age, I remember working for Transamerica Financial, in college.
Yep.
And I'd sit there and I'm doing loans. I'm giving home loans to people. And I'd go, so what's your age? And they'd look at each other. I don't know. And I'm thinking, you want me to give you money? You don't know how old you are? Are you kidding me? That's a very fundamental. Yep. But now I get it, right? Yep, sometimes I'm saying, I think I'm.
Yeah, let's see. You ask your wife, how old am I?
So now I get it.
I hear you. I know. It's how funny how time goes. All right, we're talking about unlocking the leverage out of your the equity out of your home to leverage it, right? So when should you leverage your real estate? This is the big question we're trying to answer. So as we went through last segment, when the cash flow easily supports the new debt, right? Remember, as Dwight said, rental or personal income must comfortably cover the payment. Stress test it, 10 to 15% drop in rents. Can you afford that? Or a 2% rate increase on a refi if you go the variable side. And again, we want to avoid any type of razor thin margins. Now, Dwight, this is still you. Then I'm going to come to you, Corey. When you can deploy equity into higher, well, actually, this would be Corey's. When you can redeploy, I should say, equity into higher return assets. I mean, that's what we're talking about today, Corey. Again, we're not going to spend this money frivolously. What's some of the rule of thumbs you'd like to advise clients on this side of it?
I mean, the basic one is if the property, whatever you're working on, can cover the cost of the debt. So for instance, in our example, we have a 3% mortgage on maybe a 10 or 12 cap, and that may or may not be realistic that you can actually go do that. But if you can call Dwight and you have all this tapped equity, you're not using it, and he can give you debt for 4%, and you have a good property that you've studied, you know the numbers, you're very confident of what it can do, and it can return 8%, 10%, somewhere in there. And that would make a good argument to invest that money. And depending on where you're pulling the equity from. Now, to me, if you're pulling it from your primary residence, you're going to be a little bit more conservative than if you're pulling it from another investment property that you're just working, through the equity cushion on.
So here's a question I have for both of you. Probably going to be the same answer, but Corey, I'll stay with you. What's the delta between what the mortgage rate is compared to what you can earn on a cap rate that you like to see? Is that delta 3% differential, 4%? Where's the number you're comfortable with?
Honestly, I can't say that I have an exact number because aside from the NOI, the operating income, we also look at the deal. Maybe it's got a real close operating income where it'll pay the debt, but there's potential massive upside 5 years from now because we know development's coming or something like that. So I kind of roll the whole thing in the ball wax. But I'll tell you, before we take on any debt, it's got to be a pretty select deal for us to do that, if that makes sense. We're not just going to start slapping a bunch of debt to get 1 or 2% return.
Interesting. What's your target?
10 to 15.
Yeah. And time frame?
It depends. Some of them are quick, but if you have a long term, if you're building something, let's say you have a shopping center or whatnot, yeah, you're going to be in that for 3 to 7, maybe 10 years, but you can see the upside to it because of the land values are going up. All these things are happening. Short term, maybe 12 months, long term, 10 years.
Okay. Beautiful. Dwight, same question to you. What's that delta you like to see between the cost of the mortgage and the cash flow that's going to produce the rate?
I kind of agree with Corey. It's almost a case by case because you may know something that others don't know about, which is the homework you should be doing, the due diligence before you go buy that thing. I guess for me, and this is probably way under Corey's standard, I think I would be okay with a 5 or 6% difference, which is, more around the 8%, maybe 9%.
Guys, don't we need to compare that, Corey? Go back to you. Don't we need to compare this with other similar investments, right? I hear this a lot from clients. Look, and I can get, 6% cap rate on my real estate investment. But look at the stock market is up, 15% this year, and it was up, 12% last year. And I think it's going to go up 10% next year. And they're comparing the two asset classes to one another. And as I always tell them, that's not a fair comparison because You have to look at, what real estate can do that majority of stock market investments can't, is produce the cash flow. Sure, you can buy dividend yielding stocks and ETFs and mutual funds and things, but nothing like the real estate side. So, right, Corey, we want to look at the total, what we call in the stock market side, the total return. What's our appreciation and our cash flow overall potential over a specific period of time?
And the risk. People forget the risk. And there's a reason that you can get those returns in the stock market, because you could have them one day and lose 100% of it the next. Nothing against your industry, but that's just kind of how it works. But on the flip side of that,
Man, brutal.
In the real estate
I can get
stuff,
out of mine at the flip of a button.
You always went 100%.
That is true.
You just wiped us out. Not a 10% drop.
It was not even
left
40.
out the point. I can press the button and get out, but he can't.
That's true. That is true. But I would also say if you're getting a cap rate at 4 or 5 or 6%, now for me, well, I can go buy a 10-year bond and get 4.25. So, and there's no risk there. Maybe I don't get the equity upside.
Right.
I do strike against that, if you would.
Okay.
John, do you think it's important in this day and age to be more nimble with your investments, meaning that you can tread lightly, you can get in and out quickly? Because if we start talking about real estate, which we are, I mean, it's not you know what I'm saying? It's not as flexible and nimble. You're going right in, and you better have a plan. I mean, sometimes, and not to say you don't have a plan in the stock market or different things, but do you think overall the consumer is more nimble with their investments?
I don't think the consumer is. I think that's the job of the financial advisor, to remind the consumer that they need to be nimble, right? That's where we get back to asset allocation and portfolio diversification. We need liquid cash, right? In case some life emergency comes up. We need investments that, again, maybe give us a little higher return because we can tie them up for, 2 or 3 years. And then we have longer term ones, right? Things like annuities, where we have early withdrawal penalties, but we have a lot of benefits and very little stock market risk and things like that. It really varies. And again, Dwight, that's a great question, because it all comes down to, what are your goals? What's your time period? Can you handle fluctuation and volatility in exchange for upside? And the easiest answer for most people is, there's an old theory on Wall Street. It's called the bucket strategy. Many books have been written about it. And theoretically, it works, where you go, okay, I want X% of my portfolio in liquid cash equivalent investments, a money market, short-term treasuries. I want another, 20% in, let's say, volatile investments, right? Kind of rolling the dice and hoping you're going to hit a home run. If you strike out, it's not going to be a big deal. Then you have your long-term money, right? You're going to buy big quality blue chip stocks that you're not going to touch for the next 10 to 15 years. You got annuities and life insurance and all these different things. And so that's really where the art of portfolio diversification comes into it. And what I see a lot, I'm not being biased towards our industry, but what I see when we bring accounts over from other investment firms, most of our competitors do a pretty good job as far as diversifying their clients to what I mentioned. The ones that are the worst, the ones that I see at least, are the people that self-manage their money, because they don't think about that. They get too caught up in the returns. To Corey's point, they don't look at the risk, and they're like, hey, you know what? Market's at 12%. My gosh, I better be at 12%. Now, as Jason and I always say, you should probably be up 8 or 9% if you're a moderate risk investor, right? If you have an aggressive risk tolerance, sure, you should be up matching whatever your bogey is, whether it's the S&P, the NASDAQ, Russell 2000. But if you're diversified and you're investing for the long term, you better not be matching the market. That means you have too much risk. And you can measure the risk of a portfolio, what's called beta. There's all kinds of software out there that'll tell you how risky or non-risky your portfolio is to the S&P 500. So there is a mathematical way you can measure the risk. But the bottom line is, you always have to think about that. In the more diversified portfolio, the less risk in many cases, and especially the asset classes, right? Just because you own 20 stocks doesn't mean you have a diversified low risk portfolio. But if you have 20 stocks and you got treasuries and you got annuities and all these other different kinds of investments that are non-correlated, that's a good diversified portfolio. You do not want everything to go up or down at the same time. If that's the case, just go buy an S&P 500 index fund and plug your nose and ride the wave. So, yeah, great question, Dwight. Dwight, let's sneak in very quickly. When next idea is, to leverage is when you need liquidity, but you want to retain ownership. This is a great point you brought up.
Yeah, I mean, to me, you've got lots of tools, and we've always talked about the equity to upgrade your apartment, your house, or whatever you need to do to increase the overall return. I mean, there's a lot of properties out there, and Corey has talked about it years, where you come in, you put a little bit of TLC into it, you can increase that return on that, and leverage is always good on that. So there are so many ways to take this equity that you have and leverage it back in and improve the property and improve the returns and increase the overall value. And it's a win for everybody.
So you utilize that, via HELOCs, cash out refinances, that, an alternative to selling. Because real quickly, guys, I had a situation arise last night after the show. I was speaking with a client that owns up at the lake, got $4 million of equity, and he's thinking about selling for various health reasons. And we had to calculate. I'm like, remember, it's primary residence. You only get a $500,000 exclusion. He's married. And so we had to do a capital gains calculation. A lot of people forget about that, Corey. Like, you know what? There's a lot of people, especially up at the lake and other areas, that have a lot of equity, and taxes are a consideration. We've become accustomed to not considering taxes when we sell our primary. But remember, you only got a $500,000 protection. Anything above that, if you've owned it longer than a year, you're looking at, in most cases, right around 20 to 23% capital gains. So you got to be careful and go, hey, and we talked about it. Maybe just taking some cash out or doing a reverse mortgage. We were going through all kinds of different scenarios. So every situation is different. Let's wrap it up with Kristen Snow, right now, Traffic Center. Kristen, welcome back to the Jon Sanchez Show on News Talk 7 KOH with Corey Edge of Edge Realty. Mr. Edge, your phone number?
673-6700.
Very good. Mr. Millard?
240-2022.
Thank you. All right, guys, we've been talking about, again, unlocking the equity when it's appropriate to use the equity in your home as a wealth strategy. Let's recap very quickly what we touched on. Again, when the cash flow easily supports the new debt, when you can redeploy equity into higher return assets, when the property needs value add improvements, when you need liquidity, but you want to retain ownership. And the final point, Dwight, let's go to you. When the market cycle supports it, meaning a lower interest rate environment.
Yeah, absolutely. I mean, a lot of people use that as their strategy, John. I don't support it all the time, but they get into something on the auspices that rates are going to go down. They'll be able to restructure the debt and restructure the payment, and it'll be better. So when it works out, it's fantastic, and utilize it all the time. I mean, you've got people right now that will be able to, if we can get a little more relief in rates coming first of the year, that will take advantage of that exact point.
There you go. And Corey, under that scenario, when the market cycle supports it, obviously rising rent markets with strong demand.
Absolutely. Yeah. It's just like any other business. If you can raise your price and create a bigger profit cushion, and especially if you can lower the cost of your debt, I mean, that's a no-brainer.
Corey, sorry, we're catching about every third word you're saying. I got it. I know what you're going to say, but yeah, Corey was talking about rising rent markets, strong demand, etc. All right, we're going to wrap it up with this. When should you not leverage, right? So here's the points that we put together. When your income or portfolio is unstable, makes common sense. When rates are significantly higher than historic averages, like we just came out of. And when the equity is your only cushion, or what we call your sleep well at night reserve, then you leave that in there. And I'm going to throw one more. If you're in poor health, or maybe you're coming into retirement where you don't have that ability to go out and continue to earn and bring more money in, that requires a lot more due diligence and analysis before you start tackling the equity in your home. And remember, like Corey said earlier, this is your home, right? You want to be very careful taking this equity out, because for many people, they have their home paid in full. It's been a lifelong dream. It's paid in full. And then they get an idea they want to go buy some real estate or do something else. Deal doesn't go right, and now they're homeless. So last thing in the world, of course, is you want that to happen. So just be careful. A lot of great opportunities, but once again, do your analysis. Corey, Dwight, I wish both of you a happy Thanksgiving. I'll be back with all of you tomorrow. God bless. Have a great afternoon.
Dwight Millard, NMLS ID number 241259, a licensed mortgage loan officer with Highlands Residential Mortgage Limited, and equal housing lender. NMLS ID number 134871. The information shared on this live broadcast is for general information purposes only and does not constitute financial or mortgage advice. Listeners should consult directly with a licensed mortgage professional for guidance tailored to their specific situation. All loans are subject to credit approval and program guidelines. Not all applicants will qualify. Loan terms and availability may vary by state and are subject to change without notice. Highlands Residential Mortgage Limited is licensed in multiple states. For a full list of state licenses and disclosures, please visit https://www.highlandsmortgage.com/licenses/. The views expressed during this program are their own and do not necessarily reflect those of Highlands Residential Mortgage Limited.